A lot of people die fighting tyranny. The least I can do is vote against it. Well, folks, do we have a juicy piece for you tonight? Tonight, this is an expose piece against Carl Icahn, the legendary Wall Street financier. Now, if you don't know who Carl Icahn is, he's basically probably in the top 100 wealthiest people in the world, and he runs a company very similar to, Warren Buffett, a holding company called Icahn Enterprises. And he became famous in the 80s, essentially being called a vulture capitalist, as opposed to venture capitalist, a vulture capitalist. Also, another one of his names was Corporate Raider, where he would essentially buy a ton of stake in public companies and then, bombard the capital partners and require that they make corporate changes and even, kind of try to take companies hostage in this manner, corporate takeovers, to get them to sell their assets and reap a profit. So Carl Icahn, this is what he's famous for today. He owns Icahn Enterprises, of course, which is a holding company that has a bunch of different companies inside of it. But I wanted to look at the Hindenburg Research paper that just came out earlier today. And Hindenburg Research is quite interesting. They have posted a lot of what some people call hit piece articles about companies, about, investors, hit piece articles talking about, hey, they're doing something wrong here. This isn't looking good. And they've gotten a lot of flack, actually, because they also do disclose in a lot of their articles that they've taken active short positions against the companies that they're making this research about. So it's a bit controversial. You get to the point of thinking, are they a big, research enterprise with the sole goal of just writing short hit pieces so that they could short companies? And of course, shorting a company is taking a position in the case that if the stock loses money, the short seller is making a profit off of that degradation of the stock. So I just wanted to get to the article for tonight. Actually, this is Hindenburg Research, Icahn Enterprises, the corporate raider throwing stones from his own glass house. So we're just going to go through the article and actually look at what this research is about and what Hindenburg Research is speculating about Icahn Enterprises. Icahn Enterprises is an $18 billion market cap holding company run by corporate raider and activist investor Carl Icahn, who, along with his son Brett, own approximately 85% of the company. Our research has found that IEP, Icahn Enterprises, units are inflated by 75% plus due to three key reasons. One, they trade at a 218% premium to its last reported net asset value, vastly higher than all comparables. Number two, we've uncovered clear evidence of inflated valuation marks for IEP's less liquid and private assets. Number three, the company has suffered additional performance losses year to date following its last disclosure. Most close-end holding companies trade around or at a discount to their NAVs. For comparison, vehicles run by other star managers like Dan Loeb's Third Point and Bill Ackman's Pershing Square trade at discounts of 14% and 35% to NAV, respectively. We further compared IEP to all 526 US-based closed-end funds in Bloomberg's database. Icahn Enterprises' premium to NAV was higher than all of them, and more than double the next highest we found. So essentially, to boil this down, what they're saying is, right off the bat, something smells fishy because Icahn Enterprises is trading way above comparable value to where everything else is. Now, of course, things can do this, such as Tesla. Tesla trades at a price to earnings ratio of 40 to 50 on any day, whereas the broad stock market trades at price to earnings of 15 to 20. So companies and funds can be pretty high above their competitors in the market. Some would say that there's going to be a correction due eventually, but that's just what this first bit of the article is pointing out, that it is way overpriced compared to its competitors. A reason for IEP's extreme premium to NAV, based on a review of retail investor-oriented media, is that average investors are attracted to 1. IEP's large dividend yield, and B, the prospect of investing alongside the name, Carl Icahn, who's a Wall Street legend. Institutional investors have virtually no ownership in IEP. So Icahn Enterprises, and this is where it gets really interesting, Icahn Enterprises' current dividend yield is 15.8%, making it the highest dividend yield of any U.S. large cap company by far, with the next closest at 9.9%. That's really insane. That's a really insane dividend yield. As a result of the company's elevated price, its annual dividend rate equates to an absurd 50.5% of last reported indicative net asset value. The dividend is entirely unsupported by IEP's cash flow and investment performance, which has been negative for years. IEP's investment portfolio has lost 53% since 2014. Wow. The company's free cash flow figures show IEP has cumulatively burned $4.9 billion over the same period. So right now, right off the bat, I'm just thinking, I'm comparing this in my mind to Warren Buffett's Berkshire Hathaway, because they're, fundamentally very similar situations. Not all this talk of fraud and stuff, but very similar in the fact that Carl Icahn and Warren Buffett, both financiers and Wall Street legends, and Berkshire Hathaway's and Icahn Enterprises are both holding companies that own a ton of different companies. So, essentially what this article is alluding to is that the holdings within Icahn Enterprises, they're not doing too well. And we're going to figure out why. Despite its negative financial performance, IEP has raised its dividend 3 times since 2014. IEP's most recent dividend increase came in 2019, when it raised quarterly distributions from $1.75 to $2 per unit. IEP's free cash flow was negative $1.7 billion in the same year. So let's figure out. In brief, Icahn has been using money taken in from new investors to pay out dividends to old investors. Such Ponzi-like economic structures are sustainable only to the extent that new money is willing to risk being the last one holding the bag. The classic Ponzi scheme scenario that Hindenburg Research is accusing Carl Icahn of engaging in. Supporting this structure is Jefferies, the only large investment bank with research coverage on IEP. It has continuously placed a buy rating on IEP units. In one of the worst cases of sell-side research malpractice that we've seen, Jefferies Research assumes in all cases, even in its bear case, that IEP's dividend will be safe into perpetuity, despite providing no support for that assumption. Very interesting. Adding to evidence of IEP's unsustainability, we estimate that IEP's last reported indicative year-round NAV of $5.6 billion is inflated by at least 22% due to a combination of overly aggressive marks on IEP's less liquid and private investments and continued year-to-date underperformance. In one example, IEP owns 90% of a publicly traded meat packaging business that it valued at $243 million at year-end. The company had a market value of only $89 million at the time. In other words, IEP marked the value of its public company equity holdings 204% above the prevailing public market price. Well, that's really crazy. That's interesting. I'll skip ahead a little bit. It's just talking about different divisions of the holdings company. IEP reported $455 million in real estate holdings in its most recent quarter. The reported values in the segment have been remarkably stable for years, despite declining net income and despite including the Trump Plaza in Atlantic City, which was razed to the ground in 2021, a country club that became nearly insolvent in 2020, and 3, a lack of transparency on other assets and valuations. That's really interesting. Now, I'm reading ahead here, and I think this is probably one of the coolest parts of this analysis for me, is they failed at short selling the market. IEP disclosed that its investment fund had a 47% notional short bet in its December 2022 filings. Given the positive market performance, we estimate this short bet has contributed at least a further $272 million in year-to-date losses. Let me get this straight. December 2022, right? The bottom of the market. Essentially, when everything is at its lowest, right? And then we have a rally right at New Year's. We have a New Year's rally in the stock market. The NASDAQ is up, probably, 15 to 20% right now on the year. So they had a 47% notional short bet, and it's contributed to at least $272 million in year-to-date losses. I mean, that is pretty substantial, given that we read earlier that the fund is essentially valued at around $18 billion. Overall, we estimate that IEP's current NAV is being closer to $4.4 billion, or 22% lower than its disclosed year-end indicative NAV of $5.6 billion. So essentially, they're over-reporting, and overall, we think Icahn, a legend of Wall Street, has made a classic mistake of taking on too much leverage in the face of sustained losses, a combination that rarely ends well. Okay, everyone, so that's it for today's video. I just wanted to go over the little bullet points as this article just very recently came out. This research just recently came out. Maybe in the coming days, we'll see, what goes on, what happens with this company. Essentially, the most interesting part is that the dividend yield of the fund seems astronomically high, 50.5% for dividend yield. It's very unsustainable, and that money seems to be coming, as Hindenburg Research alludes to, coming from A, Carl Icahn's own pocket, and B, coming from money that's actually coming into the fund from other investors, which of course, if allegations are true, would be a classic Ponzi scheme maneuver, which of course is illegal. And we also saw today that Icahn Enterprises company's stock decreased about 20% in value. So they definitely lost big. And we'll look at this last bullet point, like what I told you earlier, initial disclosure. After extensive research, we've taken a short position in units of Icahn Enterprises. This report represents our opinion, and we encourage every reader to do their own due diligence. Thought this was an insanely crazy article, another heavy hitter by Hindenburg Research. Again, my name is Bruce. If you're new to the channel, hit that subscribe button. I'm posting a lot of stuff all the time on finance, investing, money, etc., etc. So I look forward to seeing you in the next one, and have a good night. Bye.